Welcome to another deep dive. Today, we're not just looking at numbers. We're trying to take a shortcut to really understanding the latest economic pulse. We've got this comprehensive weekly financial and economic bulletin from July 7, 2025, right here. And it's packed with data points that, well, when you connect them, they tell a really fascinating story.
Sometimes a challenging story, too.
Exactly.
Yeah.
About the current economic landscape, like a puzzle.
Yeah.
Yeah. And we're going to try to put the pieces together for you.
Yeah, precisely. This bulletin offers a critical, kind of unfiltered snapshot of economic health, both here and internationally.
Right.
Our mission, as always, is to sift through these raw figures, distill them into clear, actionable insights. We want to help you not just grasp what's happening, but maybe more importantly, understand why these shifts matter, to your daily life, your world.
Okay, let's start unpacking this economic puzzle then. Yeah. We're going to explore, everything. From the intricacies of foreign trade balances, the persistent burden of inflation, right through to the rising tide of debt, individual and business debt, and even some pretty significant global market shifts.
It's a lot of ground to cover.
It is. But we'll guide you through it. So let's kick things off with the domestic economic picture, specifically what the bulletin tells us about foreign trade. The headline isn't exactly rosy. It points to the foreign trade balance remaining weak. What exactly are the specifics there? What does weak really mean, like, in terms of impact?
Well, what's fascinating here is this delicate balance, or maybe imbalance we're seeing. In May 2025, the numbers show exports actually increased by 2.6% to $24.8 billion.
Okay. Sounds positive on its own.
It does. However, imports also rose by 2.7% up to $31.5 billion. So when you put those together, it resulted in a trade deficit of $6.6 billion.
Right. So we're still importing significantly more than we're exporting.
Exactly. This gap, while it's not spiraling out of control, it signifies this continued weakness in the ability to earn foreign currency through exports versus what's spent on import.
And for you, the listener, what does that mean?
Well, a persistent trade deficit like this, it can eventually put, downward pressure on the local currency, and that makes imported goods more expensive.
Gotcha. And the currencies used in these trades and who we're trading with, that tells the story too, right?
Absolutely. The bulletin reveals that about half of all imports are done in U.S. dollars, while half of the exports are in euros. This currency split, it really highlights key economic relationships where the major financial flows are coming from.
And the partners.
Yeah, trade partners. For exports, it's mainly Germany, the UK, and the US leading the way.
Right.
On the import side, China, Russia, and Germany are the top sources. But here's a really interesting point, almost geopolitical.
Oh, yeah.
We saw a significant drop in imports from Russia in rubles, down a staggering 78.72%.
Wow, 78%.
Yeah. But conversely, exports to Saudi Arabia, paid in their currency, rials, saw a sharp rise of nearly 149%.
That was huge.
These aren't just numbers, These shifts, they speak volumes about changing global alliances, maybe supply chain shakeups.
Yeah, those shifts, Russia down, Saudi Arabia way up, that really does speak volumes about bigger geopolitical changes, doesn't it?
It really does.
It's also worth noting the composition of this trade.
Yeah.
Particularly when it comes to technology. The bulletin says high-tech products are only, 4.0% of total exports?
That's right, just 4%.
Yet they make up 10.0% of imports. That disparity. What does that suggest about our domestic production, our reliance on external innovation?
Well, that disparity is quite telling, and it really signals a kind of fundamental strategic vulnerability.
How so?
It means that domestically, there's a much lower proportion of high-tech manufacturing that's geared for export. The higher percentage of high-tech imports indicates a heavy reliance on foreign advanced goods, foreign technologies.
Instead of making them ourselves.
Exactly, rather than producing them ourselves. For you, the listener, this translates potentially to fewer high-paying, future-proof jobs at home, and a persistent reliance on global supply chains for critical advancements. In an unpredictable world, this fundamentally impacts a country's long-term economic independence, its competitiveness. It creates a scenario where you're mostly a consumer of cutting-edge tech, not a creator.
Right. That makes sense. Shifting gears now from international trade, let's turn inward, to the engine of our domestic economy, industrial production.
And the bulletin paints a concerning picture here. It says it's feeling the strain.
Feeling the strain is a good way to put it.
What are the key indicators showing us?
Indeed, the engine seems to be sputtering a bit. Industrial production in June actually contracted by 3.1% on a monthly basis. That's a significant slowdown.
3.1%. Okay.
And to put that into perspective, the ISO manufacturing PMI, that's a key indicator, comes from surveys of purchasing managers about activity and outlook.
Right, the PMI.
Yeah, that dropped to 46.7. And remember, anything below 50 signals contraction.
So the manufacturing sector is actually shrinking. It is. It signals reduced orders, reduced production, and that can have ripple effects across the whole economy, from raw material suppliers all the way to, transportation.
And what does that contraction in industry mean for jobs? How quickly does that ripple through to the labor market?
Well, unfortunately, the contraction in industrial activity often translates pretty directly to the labor market. Unemployment officially rose to 8.4% in May.
Okay, 2.4%.
But what's even more striking and maybe more revealing about the true state of affairs is if we look at the broader definition of unemployment.
Which includes?
That includes people who are underemployed or discouraged workers who've just given up looking for work.
And that number is?
That figure stands at a significant 31%.
31%. Wow.
Yeah, this isn't just about a few job losses. It reflects a much deeper, more systemic challenge in the labor market. It impacts a huge portion of the workforce, signals a real struggle to find meaningful employment.
And connecting that struggle to daily life, to the very real pressures on households, the Bulletin also highlights a deeply concerning statistic. The hunger line.
Yes.
What does that number reveal about the cost of just, eating for families? And what's the real human impact?
Yes, the hunger line. It represents the minimum amount of money a family of four needs just to survive, purely on food costs.
Right.
That increased to 26,115 TL in June. Now, when you compare that to the minimum wage, there's a staggering 4,011 TL gap.
Over 4,000 TL short. Just for food.
Just for food. This isn't just financial discomfort, it's a profound social challenge. When basic sustenance becomes almost a luxury, it fuels social inequality, it can impact productivity because of poor health, and tragically, it limits opportunities for the next generation. It's a powerful, very raw indicator of economic stress hitting at the most fundamental level for millions.
Okay, let's talk about inflation. The bullet says it's falling but still high. Falling sounds good, but what are the latest numbers telling us about that persistent burden? How much is it still hurting consumers and businesses?
Well, consumer inflation reached 35.05% annually in June. The monthly rate was 1.37%.
Okay, so the monthly rate is lower than it has been.
But 35% annually is still exceptionally high, right? It's continuously eroding purchasing power.
Definitely.
And producer inflation, GOOF, which often gives a glimpse into future consumer prices, that was 24.45% annually.
And food specifically, that's often the most painful one.
It is. Food inflation, according to separate Turk iş data, remains particularly high at 37.6% annually.
Oh, ouch.
That directly impacts everyone's grocery bill. It makes basic necessities a luxury for some. It just means your money isn't stretching nearly as far as it used to.
And were there any particular sectors standing out with even higher price increases? Maybe surprisingly high.
Absolutely. Among the different consumption groups, education costs saw the highest annual price increase.
Education, how much?
It surged by an astonishing 73.33%.
33%.
Yeah. This isn't just a number. It means a huge added burden for families trying to provide for their children's future. It could potentially limit access to vital services, impact long-term social mobility.
Wow, that's huge.
Other areas like clothing and footwear saw much lower increases or even slight monthly decreases. But education really stands out as a major, painful pressure point.
Okay, from those broad economic indicators, let's zoom in on something that impacts everyone directly. Financial health, households, businesses. The Bulletin dives into mounting debts and business distress. What's the situation with individual credit card debt? And how worried should we be about the debt that isn't being paid back?
Well, the figures are quite concerning, honestly. Individual credit card debt kept climbing, reaching a massive 2.2 trillion TL.
Trillion?
Yeah. But the real alarm bell, I think, is the increase in non-performing credit card debt. That's the debt people aren't paying back.
Yeah, what's happening there?
It climbed to 92.5 billion TL, and that represents a whopping 139.99% annual increase.
140% increase. In defaults.
In non-performing debt, yes. This isn't just a small bump. It suggests a rapidly growing struggle for individuals to meet their financial obligations. It indicates pretty widespread financial stress, and maybe a potentially ticking time bomb for household balance sheets.
That sounds serious. And what about businesses? Are they facing similar pressures, or are they weathering the storm better?
Businesses are definitely feeling the heat too. It mirrors the individual struggles in many ways. We're seeing a significant rise in business distress, a trend that really warrants serious attention.
Like what?
Well, in June alone, 450 firms filed for concordat.
Which is like a restructuring process, right, to avoid bankruptcy?
Exactly. It's a legal lifeline, basically. It lets companies try to restructure their debts under court protection.
And 450 in just 1 month.
Yeah, and that brings the total for 2025 so far to 2,223 firms. It's a clear sign of widespread financial difficulty, the struggle for survival many businesses are facing.
Anything else?
Yes. Alongside that, the value of unpaid checks, bounced checks, essentially surged to 18.6 billion TL. That's a 68.81% monthly increase.
Huge monthly jump.
Huge. This metric directly reflects severe liquidity challenges. Businesses are having trouble paying their immediate bills, keeping operations running smoothly.
So with all this rising debt for individuals and businesses, what does it mean for the banks themselves? The Bulletin says they're profitable, which sounds good, but also notes that risks are increasing. How do those two things fit together? Is this like a calm before the storm scenario for the banks?
That's a crucial distinction and a really insightful question, actually. Banks' net profits did see a substantial 45.7% annual increase, reaching 62.3 billion TL in May.
Pretty profitable then.
Very. And this profitability is partly driven by the high interest rate environment, plus growth in lending. Consumer loans up 43.6%, commercial loans up 23.5% annually. So, yeah, they're earning more from loans. But while they're profitable, the underlying risks are building up. Precisely because of that increase in non-performing loans we just talked about, for both individuals and businesses.
So the profits look good now, but the potential losses down the line are growing.
That's the concern, yes. Also, the central bank's net foreign exchange reserves, if you exclude swap agreements, they continued to decline, reaching a lower $28.4 billion.
Okay.
And these currency-protected deposits, KKM.
Right, the accounts designed to protect savings from lira depreciation.
Exactly. Those are falling. They dropped to 544 billion TL. This could suggest waning confidence in that mechanism, or maybe shifts in investor strategy. Either way, it signals potential renewed pressure on the lira and the broader currency market.
So lots of factors pointing to potential vulnerabilities under that surface profitability.
Right. It suggests a need for caution, certainly.
And if we connect this to the bigger picture, what does the real effective exchange rate, the rate here, tell us about the Turkish lira standing internationally, especially given those trade deficits we started with?
Well, the REIR has continued to decline. In simple terms, that means the Turkish lira has depreciated in real terms against a weighted average of currencies of its major trading partners.
Okay, so the lira is weaker in real terms.
Yes. And while a depreciated currency can, on one hand, make our exports more competitive, cheaper for foreign buyers, on the other hand, it makes imports much more expensive. Yeah. Everything from raw materials to consumer goods.
And that feeds inflation again.
Directly. It adds costs for imports, fuels domestic inflation. It creates a significant challenge for consumers and businesses who rely on imported goods or materials. So it's truly a double-edged sword impacting both trade and your purchasing power.
Okay, let's zoom out now. Look at the global economic landscape outlined in the Bulletin. It paints a picture of, well, quite a mixed global pulse. Almost a tale of diverging paths, wouldn't you say?
Absolutely. The global picture is indeed a tale of multiple economies moving at different speeds. You have the U.S. economy continuing to show considerable strength. It's almost acting like a global anchor, right? With its low unemployment at 4.1%, manufacturing and services PMIs generally rising.
It's pretty robust over there.
Yeah, indicating expansion. But then you see a starkly different story in Europe and China. Each is grappling with its own unique challenges, slower growth.
Interesting contrast.
Yeah. And for example, Germany's consumer inflation being 0.0% monthly in June, that stands in fascinating contrast to the persistent inflation we see elsewhere, including here. It really highlights just how divergent economic pressures and policy responses are right now across the globe.
That's a great point about the divergence. Speaking of the U.S., though, despite those strong overall indicators, we also saw some surprising employment figures from them. What was the nuance there?
Indeed. While indicators like, say, the JOLTS job openings were strong, the ADP non-farm employment report showed an unexpected decrease of 33,000 jobs in June.
A decrease? That's surprising.
It caught many analysts by surprise, yeah. And the overall non-farm payrolls, while still positive, came in lower than expected at 147,000. These specific figures suggest that even in a strong economy, you can have pockets of volatility in the labor market, or maybe just a more nuanced picture of job creation than the broader trends initially suggest. It reminds us that even robust economies aren't perfectly smooth sailing.
Good point. What about the markets themselves? How have currencies and commodities been moving over this past week? What might that tell us about investor sentiment?
Yeah, the market saw some interesting shifts. The USD-TRY exchange rate edged down just slightly from 39.9 a ZIR to 39.81 TL,
Right.
while the Euro IOD rose a bit from 1.17 to 1.1775.
Right.
Shows maybe a little dollar weakness against the
And
euro.
about commodities, gold, oil.
Gold prices continued their upward trend, reaching $3,337.25 per ounce. That usually indicates continued investor demand for, safe haven assets amidst global uncertainties.
Makes sense.
And Brent crude oil also increased, up to $68.30 per barrel. Reflects global energy market dynamics, maybe expectations of continued demand.
What about the local stock market?
Domestically, the BIST 100 index in Istanbul saw a strong 8.7% rise in TL terms. That suggests some confidence among local investors in the Turkish market, perhaps seeing value in current valuations despite the headwinds.
Interesting. And were foreign investors interested in Turkey during this period? Despite some of the domestic economic challenges we've discussed, seems like a tricky decision for them.
Yes, surprisingly, perhaps, the data indicates continued foreign interest, which is a positive sign for capital inflows.
Really? How much?
In the last week of June, foreign investors made net purchases of $305 million in government bonds and $248 million in stocks.
Okay, so still coming in.
Yeah. It suggests that despite the domestic challenges, there's still a segment of the international investment community seeing value or opportunity in Turkey, maybe betting on future recovery or specific assets. And it's worth noting, too, that Turkey's overall external debt stock reached $527.5 billion in Q1 2025, which sounds huge.
It does.
But its ratio to national income actually decreased slightly to 38.5%, which is seen as a relatively positive sign in terms of the economy's ability to service that debt relative to its overall output.
Okay, so putting all these pieces together, what does this mean for you, our listener? This deep dive into the July 7th Bulletin, it paints a picture, doesn't it? An economy facing, significant domestic headwinds, particularly around rising debt, that persistent, painful inflation, and the contraction in industrial output. Yet there are also areas of strength, like banking sector profitability and that continued foreign investor interest.
It's a complex picture.
Very complex, very nuanced. Certainly not black and white.
And it really highlights how interconnected all these indicators are, doesn't it? A slowdown in industrial production that can quickly reflect in rising unemployment, higher hunger lines. And similarly, rising individual and business debt can impact financial stability right across the board. Understanding these dynamics, how they feed into each other, it's crucial. Crucial for making informed decisions.
Whether you're running a business, managing your household budget,
or just someone trying to grasp the economic currents around you, it's about seeing the threads that connect these seemingly disparate numbers.
And this raises an important question, I think, for you to ponder, especially given the patterns we've seen in trade, where imports of higher tech products outpace exports, and that overall weakness in the foreign trade balance. It brings to mind that powerful proverb, "He who does not produce imports. He who imports becomes dependent."
A powerful thought.
What does this insight suggest about the long-term economic path for any nation, and the kind of resilience truly needed in our increasingly globalized, interconnected world? Something to think about. Join us next time for another deep dive.